Hello, good morning, good afternoon, good evening to all of us, all of you who are watching us. It's our pleasure to end this spring semester series with a paper presented by Steve Quinn. The co-author, Bill Roberts, will be lurking in the shadows, uh, just in case. And Steve is going to talk about the metal flows at the Bank of Amsterdam in the 18th century. So just to remind people, we go 40 minutes uninterrupted. Please put your questions at the Q&A button at the bottom of the screen. If there is an urgent clarifying questions, I'll stop Steve, but otherwise we'll run through the 40 minutes and then we'll open up for Q&A. At the hour, we formally end the seminar to be continued with 15 minutes of an informal discussion. So without further ado, Steve, the floor is yours.
All right. Excellent. Are we good?
Yes.
Yeah, we're good.
Thank you, so. All right. Well, thank you, Nathan and Rui, for the opportunity to present co-authored work with William Roberts on the Bank of Amsterdam. And I'm going to be focusing on chapter 6 and a bit of chapter 7 of our book, How a Ledger Became a Central Bank. So some background, if you will. The Bank of Amsterdam in the 18th century was arguably the most important and leading financial institution in Europe until maybe the rise of the Bank of England late in the century. It was city owned and operated. It was a municipal public bank. In the image here, it was on the ground floor of the large building on the right, the City Hall of Amsterdam. And in the day, it was very well known for two things. It supplied a very popular money, a ledger money. It only existed on the books of the Bank of Amsterdam, and it was used primarily to discount and settle bills of exchange in the city. And it was, again, very popular for this function, but it was also a very popular place to park, if you will, the great trade coins of the day, Spanish dollars and gold ducats. And if you read Adam Smith or any of the authors of the era and they talk about Amsterdam, both of these features will figure prominently in their conversation. But what has not been known is the inside story, because much of what the bank was doing was private information, known only to the directors and the insiders of the bank. These included the balance sheet, its loans to the Dutch East India Company, how much the city was taking from it in profit each year, so the exploitation, if you will, of the bank by the city. And for our particular purposes, the monetary policy of the bank, what it was doing and why it was doing it, how it was managing its money. And so our book is part of our long-term project of bringing all this to light. And our argument then for this presentation is going to be that the bank was particularly managing two distinctly modernish features or ways of mechanisms. One is passive, we're going to describe it as, meaning the bank is letting the customers decide when and how much to alter the amount of bank money and interact with the bank. But then also actively, that is, the bank is deciding when and how much. And it's not just one or the other, but the combination of the two was how the bank was managing to be so successful in the 18th century, keeping both its money and as a place to market and move coin. And those two complemented each other. So with that, I also want to add some motivation that the Bank of Amsterdam had interesting similarities to modern central banking. Say, compared to the modern Fed, they both offered accounts that were used as reserves and the means of settlement for the core of the financial system. And both those accounts were irredeemable, or what today we would call fiat. The account themselves had no right of redemption at all. But both banks then and now managed that money through its interaction with the primary safe assets of the day. And of course, modern central banks do this with sovereign debt. And the Bank of Amsterdam instead used the great trade coins of the day, more than anything, Spanish dollars. Now, how that interaction occurs, we characterize in two ways. Passive, meaning the central bank is letting the customers, if you will, decide when and how much. Now, modern central banks have been sort of getting back into this process through, say, the Fed's overnight repo and especially reverse repo facilities, so-called standing facilities. And the point today is going to be that the Bank of Amsterdam did this to a great extent all the time. It was its primary way of engaging with the public. But then also, central banks then and now have active policies. But again, we mean the bank is deciding when and how much to interact its money with the safe assets of the day. And of course, central banks today are famous for this through open market operations, quantitative easing and tightening, with a eye towards stabilizing macroeconomic mandates. While the Bank of Amsterdam had no such macroeconomic mandates, but it certainly did so, as I'll show you, with an eye towards stabilizing the total amount of its money and interacting or a response to the passive facility it used through what's going to be called the receipt window. And so we think these parallels, not identical, of course, but similar enough to be interesting, is another motivation for our study of the Bank of Amsterdam. So putting the bank in its context, there was a number of different kinds of monies in Amsterdam in the 18th century, of which the bank money was only one. And it was paper as compared to metal, and it was international in its usage, in the sense that it was primarily used to transact international bills of exchange. While to be stressed, the money itself never left the Bank of Amsterdam, because the money itself was in fact a ledger credit or debit, and that's the only form it took in the 18th century. And as a background, our primary empirical exercise in the book and our long series of research has been to encode all these transactions that you're looking at and digitize them, and then reconcile them into a balance sheet. So this is what bank money looked like, and what it was. So this bank money was used then to transact in bills of exchange. The great merchant banks of Amsterdam used the bank money to discount and settle its bills. And Amsterdam at the time was the leading bill market of Europe, again, until perhaps London took over in the late 18th century. And so this was a great function. And it's what the bank, if you will, was central to. It was central to the high-end bill market in Amsterdam. But what was central to the bank, if you will, were coins. And in the 18th century, Spanish dollars, gold ducats were the dominant safe asset. Those would be international trade coins. But the Amsterdam and the Dutch Republic also had a great deal of domestic money. It didn't really leave the Republic. It's what was used for local payments, so-called local money, or guilder coins. And we would also put in, as a background, bullion, because this is what, of course, coins could get turned into and were minted from. And so that creates an ecosystem all of its own. And so this is the world the bank found itself in. And appreciate how much metal was on the move in the 18th century. So New World production of silver was already substantial in the previous century and was on the increase throughout. So there was this constant rising flow of silver crossing the Atlantic every year. Hundreds of tons of silver was coming over. And also in the 18th century, there was also a great deal of gold coming over. Gold had been relatively modest gold production in the previous century, but in the 18th century, there was a surge in gold, especially from Brazil. And so there was also a great deal of gold flowing. So the bank's living in a world with a great deal of metal coming across the Atlantic, flowing through Europe on its way to Asia. And we think of, if you'll forgive the modernism, the bank as a platform of platforms. So bills are one platform, these trade coins, the Spanish dollars and the gold ducats were another platform, and the bank is in the middle, creating, offering, if you will, a hyper liquidity to interact these platforms. And that's sort of its position as a central bank, central to bills and coins being central to it. So I want to focus mostly on the passive story. Again, this means in our lingo, the bank is letting its customers decide when and how much bank money to create. And this occurred through what was called the receipt system or the receipt facility. Again, the modern analog would be a standing facility. The bank offers a price, people can bring in their coins to acquire bank money when and how much they want. And so it's that connection there in the map. Now, all this is quite different than what's going on, say, in London and the Anglo-American banking model that would follow. So, to quote a source of the day, in the Bank of England, gold, silver, and credit runs promiscuously. But in Amsterdam, they are separate things. And so one needed to understand this if you're a universal merchant in the 18th century. So how were they separated? Well, again, customers could use this receipt system, which is, we're going to point out here, very analogous to a repurchase agreement, an optional repurchase agreement. So here's how it worked. And I want to walk through it because most people are not familiar with all this. So this is an actual example. Samuel Kaiser, a dealer in coins, brings 6,000 gold ducats to the Bank of Amsterdam. And upon delivery, receives 30,000 bank florins in account because the bank gave 5 bank florins per coin. So Kaiser's account is credited for 30,000 bank florins. And again, these accounts themselves have no inherent right of redemption. They're irredeemable. You can move them around, but you cannot take them in and out, rather like reserve accounts at the Fed today. But Kaiser would also receive a receipt for his 6,000 coins, and this receipt was the option to repurchase the same amount of coins at the same price within 6 months at a 1/2 of 1% fee. So it was an American option in the sense that he could exercise at any time during the 6 months. And at the end, if he wanted, he could pay just the fee, the 1/2 of 1%, and roll over or prolong that option for another 6 months. And he could do that as long as he wanted. But the receipts here are not money. You don't pay anything with them. They are an option contract, a repurchase agreement that one can use to reacquire the coins. So this is how someone like Kaiser could choose to create bank money by surrendering this safe asset as, if you will, collateral and receive both the money and the contract. And the bank liked this, and this was the start of the receipt process with people choosing to do this. Now, a neat feature of receipts where they were negotiable. So Kaiser could, and in this case did, sell half of his receipts to the great merchant banking house Pell's. We don't know the price, which we did, but the records show that Kaiser did sell to Pell's. And 5 months after Kaiser's initial transaction, Pell's repurchases half the amount of gold ducats that Kaiser had put in. So Pell's is going to repurchase or purchase from the bank 3,000 gold ducat coins. He's going to have to pay 15,000 bank florins plus 75 being that 1/2 of 1% fee and surrender the receipts, those are the authorization to do this. In other words, he has to execute the option. And this happens. So that's in the books. And remember, the money's coming out of Pell's account, not Kaiser's account, so the accounts are quite separate from each other. And this would be the throughput or the unwinding of the transaction. Kaiser brings it in, Pels takes it out, the gold flows through the bank. So the structure of their receipt facility is all around throughput. Now, this example we use in particular because it shows the other thing that can happen, of course, which is the receipt might not be executed. It might languish or expire. And this happens to, in this case, to the other half of Kaiser's receipt. So Kaiser does not pay to prolong the receipt. No one uses the receipts to repurchase the coins, and the options just expire, they disappear. That changes the status of the ducats that the bank had from Kaiser from being something they would have to potentially hand back if someone like Pels repurchases them to now falling into the bank was a terminology. It becomes owned outright now by the Bank of Amsterdam. And similarly, 15,000 of the bank's money, the bank florins of account, also lose their potential right of redemption. Now, they're just, again, like a modern fiat money. No one can make the bank do anything it doesn't want to do with them. And so that was the sort of thing that could happen with the receipt creation and throughput. You want in, Will?
Steve, if I may add just one little editorial comment. I think part of the genius of the system that comes out from this example is that Kaiser, I mean, the way he purchases his coin, he probably uh, buys them by drawing a bill on one of the big merchant banks. And so he's able to settle that bill with the coin that he's deposited, but he holds onto the receipts. And the receipts are a levered position, in these coins, which, unlike sort of modern leverage arrangements like futures contracts or repo, he's never going to face a cash call. Those options are a very clean way for Kaiser to get leverage, and so this obviously contributes to the density of coin markets in Amsterdam. And I'll stop there.
Yes, absolutely. And of course, the merchant bank's Pels are playing on both sides, and if will, making a market maker for both credit and for bank money and for the coin. So they're, on behalf of the bank, if you will, out in the market integrating all of this. So following on Will's point, this was ridiculously popular. Everyone loved this system. So this is actually the mint master for Frederick the Great commenting on all of this, that by this means coins are effectively doubled or twice put at the disposal of commerce, since the merchant can make use of the money as bank money, all the capital that he's placed in the bank. In addition, he remains master of his money, the coins, and by repayment of the sum advanced is authorized to either withdraw it himself or sell it to others. And we want to stress that this dual feature of the receipt system is also why repurchase agreements today are so popular. A great dealer today, like Goldman Sachs, can put collateral up for repo, use the money, do it at once, and still, in a sense, retain control of that collateral, which it can reacquire by unwinding the repurchase agreement. So then and now, this is a very popular structure for making use of safe asset collateral. So with that, how much of this was going on? Everyone knew the first part. Everyone knew what we just talked about. Again, you Smith, whatever. This was all very well known, but how did it actually work in quantity? Well, this was the main quantitative exercise of our book in this chapter, is then the amount of, if in this chart, the silver moving through the bank annually. So this is a flow, not a level. And the amount per year going in is on the positive, and the amount going out each year is on the negative. It's in millions of bank florins on the left and tons of silver on the right. So for any given year, the net change is in gray. So some years had a net increase in silver under receipt, and some years had a net decrease in silver under receipt. And that would have been known to the people who run the bank in the balance sheet, but only once a year, that they even knew the gray part. The black lines, which are the inflow that is matched by an outflow within that year by construction, wasn't even known to the people running the bank. And it's, first of all, fairly substantial, averaging something like 40 tons of silver a year moving through the bank, and also highly variable. Some years are pretty low, some years are pretty high. It was moving all over the place. So it was a very active but volatile story. And so this is the primary contribution of, quantitatively speaking, just getting this fact out there. So that's maybe 200,000 individual observations all summed up there. So to help put it in perspective, we can take that flow that into the top half, the input of silver coming into the bank, and divide it by the amount of silver coming across the Atlantic at the same time. Now, the silver coming across the Atlantic didn't come straight to the Bank of Amsterdam or anything like that, but just for a relative amount. And so that could again vary from fairly low to fairly high, but the average across 8 decades is 15%. And we think that's a materially significant role to play. In other words, 15% on average of all the silver crossing the Atlantic, not only pass through Amsterdam, actually much more than that pass through Amsterdam, pass through the Bank of Amsterdam per year. So it was a substantial player in the silver flow story. We want to contrast that with gold, because the bank, as you just saw with Kaiser's example, offered the facility with gold. And its story looks very different, even though it was basically the same thing. Now, gold did have a slightly higher fee, a 0.5%, while silver was only a 0.25% fee. But we don't think the slight difference in fee was really driving the rather substantial difference in behavior. So gold is on the same scale on the left-hand side, just to show you how much smaller it was to the bank story. But you can also see it had moments of that throughput that the silver had throughout the century, but often large periods of just spurts, and it just dies out and disappears. And you can see that also when you compare gold again to New World gold flows. So if you lay gold on top, when gold was moving through the bank, relative to New World flows, it could be as large, if not larger, than silver, but also had these long periods of just moribund, nothing was happening. So the same facility, gold versus silver, was having rather different stories when you actually work the numbers out. So our next question is going to be, why the difference? Why was gold so different than silver? And we're going to argue that the primary driver was the price the bank was setting for the two metals in its standing facility, the price it was setting, let's say, for the safe assets of the day. And to get at that motivation or that intuition, we're going to take a modernism and calculate a haircut. So modern repo, there's a haircut, which is the difference between the market price for a say U.S. Treasury versus what the price actually in the contract. So the price in the contract was this bank price, if you recall from Kaiser, the 5 bank florins per coin. And that bank set that, and it was a standing facility, so it was just whoever wants to come and take advantage of it, take advantage of it. Now, the market price wasn't so easy to get because it wasn't being reported in the financial press. We think largely because the bank dominated the market. But you can calculate it by imagining if you had trade coins, you could take them to the local proto bankers called cashiers, and they could buy buy those coins and give you money that could, or set you up with bank money through their everyday market for that product. And we can reconstruct that, what we call an indirect market price. Now, again, the trade coin prices weren't really available, but the bullion market by 1730 was producing regular price quotations. And so we'll use bullion instead. And the important difference here is that a coin, a well-coined, like a Spanish dollar or gold ducat would be a bit more valuable than the bullion in it because it was a trade coin. So this will be, if you will, a floor or a sort of estimate. So with that, this is the calculations of the haircuts on silver and gold for when we have bullion observations for Amsterdam in the 18th century. And you'll see for silver that throughout the decades, the haircut was always positive, 2 to 4% range. Meaning, if you brought silver to the bank, you were giving up 2 to 4%, and that's with bullion. Again, Spanish dollars would have been a bit higher still. Gold, in contrast, at least gold bullion, is very often negative. Again, we think a gold ducat would have been a bit higher, closer to zero, but the difference between then silver and gold is gold was flirting with this 0 to negative haircut while silver was not. And the key intuition being that the receipts are options. So they have a powerful asymmetry. One only has to execute them if it's profitable, and one does not need to if they're not profitable. And so silver was going to be always profitable to execute, gold not so much. So how do those two stories play out? Here's our conceptual theoretical intuition, which is just supply and demand. But if you will, there was a market then for this conversion of or movement between coins and bank money. So Kaiser and Pels in our example. Kaiser is supplying trade coins and he's looking for bank money. Pels has bank money, is looking for trade coins. They could easily have met outside of the bank and just done a side deal, and that would have been an outside price. But the bank, of course, is also offering that conversion directly at the bank price. And for silver, the bank price then was this 2 to 4% less than the outside price. There was a constant haircut, positive haircut. And because the receipts were negotiable, Kaiser could, instead of dealing with Pels outside the bank, go to the bank, deliver the coins, get the receipt, then sell the receipt to Pels, who could then withdraw it. And so the first approximation of the market value of these receipt options, these repurchase options, was the value of that receipt being the implicit haircut, that gap between the two. And we think the market price of these receipts started with that. Of course, it'd be a bit more complicated because there are options and there's more you could add to it. But as a baseline arbitrage condition, that's going to be the first thing. And so we think this is why, not just why silver was used, but why it had the throughput, that constant throughput, because people were bringing coins in, using the bank as basically the market for these coins, trade the receipt like Will described, and then the other side can withdraw the coins when they want. And so the coins come in, the coins go out, coins go in, coins go out. You get that throughput through the bank. And that's what we think is what's going on. And of course, the 18th century is a long time. A lot happens, lots of wars and all sorts of things going on. So if you will, that market equilibrium, outside price is bouncing all over the place, causing that quantity to bounce all over the place. Because for silver, the bank kept that bank price stable the entire century. They did not mess with it. And so the variation is going to be because of the outside market. And we think that variation in quantity, in throughput quantity, is what we're seeing when we get this data put up. Why it's always positive and why it's varying so much from year to year, because the circumstances are varying from year to year. And this then is what we're going to argue is the basic facility that the bank is using. It's passive and it's interacting with the public, and it's a big reason why the bank is so popular. Now, contrast that to what we're going to call the gold story, or a negative haircut, where the market price has fallen below the bank price. Well, now everything changes. First of all, there's a great incentive to bring coins into the bank because it's obviously offering a high price, and not much of an incentive to take coins out of the bank at that high price. So there's inflow but no outflow. And the receipt itself is going to have a negative value, which means it just won't be used at all, and it'll be very hard to trade. And so the throughput breaks down. As coins come in, they do not go out. A very different dynamic. And we think that's what we're seeing in situations like around 1728, 1730, where a great deal of gold was coming in. The bank decided it didn't want any more of it, and it temporarily reduced the price of gold coins, in particular Dutch ducats, to remove the arbitrage profits. And that puts a slam down on the inflows. They stop at least. But the bank has this giant quantity of gold coins it doesn't really want to have. So it starts selling them. And for the next decade, the bank's selling coins directly, not through the receipts, just directly selling them. And so no one wants to bring gold coins into the bank for a receipt because they can just buy them straight from the bank. And so the whole throughput story with silver is not happening with gold. It's just behaving very differently. And so that's our effort to show how this crossing this implicit haircut line is so important. So to summarize the passive story, the haircuts were substantial but varied through the input. And so the process that was very successful, but varying. And on the other side, though, the negative haircuts had deposits that were abandoned, and this left the bank with a lot of coins it didn't want. And this, again, was very similar to a modern standing repo facility like an overnight reverse repo. But the important difference was the bank wanted to keep its prices constant. But those negative haircuts could force it to temporarily reduce the price of bank coins to try to stem the instability. So this is the passive side. I also want to quickly mention the active side because the bank reacted to all of this. Active meaning the bank's deciding when and how much. And that story starts with the passive story we just got done with. If you take the flows we just talked about and convert them into levels, you get this picture. This is the amount of gold and silver under receipt at the bank any given month in Bank Florence. And so it's a substantial but varying amount, as you would expect. When you look at all the rest of the things the bank is doing to create bank money, like lending to the Dutch East India Company or buying and selling coins outright through open market operations, you get this gray amount of bank money. And it also is varying quite a bit. But when you stack them on top of each other, as this image does to give you the total amount of bank money, it's remarkably stable. And it averages from mid-1720s on about 19 or just below 20 million bank florins per year, plus or minus about 3 million bank florins, with the one exception of the Panic of 1763, where the amount of bank money spiked up. Otherwise, it's remarkably stable for a long period of time. And our point is that this was not an accident. The bank was instead engaged in open market operations. It was buying and selling metal and creating and destroying its own bank money. But it crucially was not using the metal that was available for receipts. It was instead was buying local coins, guilder coins. And this is what a transaction like that would look like. This is from January 69. The bank goes to a firm, Beck and Lodewijk, buys 43 sacks and change in local silver coins, and creates 25,000 bank florins. And the premium between local money and bank money was 4 and 7/8%. From 69 through early 1770, the bank's going to do 112 of these. No sales, just purchases. And the total is going to come and add up to be 3.3 million bank florins, which is a substantial amount for the bank. And it's an operation. The bank is intentionally going out and buying and building up its position this way. For example, in the previous 19 months, there hadn't been any transactions. And the bank could also sell, as I mentioned before, but it rarely sold and bought at the same time. So just to be clear, what we're doing here, we are in these images and through these operations redesigning the bank's balance sheet. So this is what the bank's balance sheet looked like if you were an insider and even knew it. The general public did not even know this. But you had metal. We had some credit loans to the city and the Dutch East India Company. And on the liability side, you only had bank money. There were no bonds or other other liabilities, and a wee bit of equity. And that equity is so small because every year the city took the bank's profits. So the bank equity gets reset to zero basically every year. And what we're doing in our images here and in our thoughts process is breaking that balance sheet into two parts. The first, the passive story I started with, is the metal under receipt. And in this 1750, that was 4.8 million bank florins. And we're just assigning that much in liabilities to it. Then all the rest of it, we're treating as a separate kind of part of the bank. That was the rest of from the image you just saw. And this is the metal they owned outright, like the local coins they just purchased, the credits. And for accounting purposes, we have to make the equity move it over so it's a negative to create, if you will, the fiat side or the active side of the bank. And so, of course, what we're doing from an accounting perspective is we're reorganizing the balance sheet around liabilities instead of assets. So the liabilities are summed up. And that conceptual break between the two is what we're doing in this image. So the black part is the receipt bank. It's only the metal on receipt. And the gray part is everything else, this fiat bank, including the open market operations the bank is engaged in. And so that's what we're looking at here. And the key point, of course, is that the gray part, the active part, is quite intentional, and it is in response to the passive part. Now, to really emphasize that, we're going to take this same information, and instead of having it over time, we're going to XY plot it. And when you take that same data and do it that way, you get this image with the receipt bank being the volume of bank florins under receipt on the vertical, and then all the rest, the fiat bank or the active bank on the horizontal. And each of those dots is a month, and the sum of those two amounts is the total amount of bank money at that time. And except for the Panic of 1763 era, that the rest of the period is remarkably stable again around that 19 million bank florin line there. And the fit is very close to -1. From everything from very low to very high, but it all fits in the pattern. Now, we are not saying that this is a high frequency, quick response. In fact, it takes the bank some time, and so there's a fair bit of noise for the bank to respond, but it does, and it keeps that total amount of bank money over, again, very long. This is 8 decades, a very long period of time, remarkably stable. Again, none of this was public knowledge in the day, but that's what's going on. And again, the one period they lose control is that Panic of 1763, where so much silver wants to come into the bank, and they just go along with it. They have nothing left to sell, and they don't try to stop it. But that passes, and then it's back to business as usual. So then the combined story is a bank that is letting the public use their receipts to when and how much they want, and then behind the scenes quietly using open market operations to stabilize the total amount of its bank money. So besides having, I think, a fascinating historical example, I think there might be some interesting modern central banking takes on all of this, which is especially given, say, in the U.S., the Fed is finding its way back into standing facilities. That first of all, these passive facilities like overnight reverse repo at the Fed right now can be very popular and very volatile. And I think the 2021-22 episode, for example, is a good example of that. That these policies, these passive policies, can get big fast. And so as the Fed gets back into these sorts of things, to be aware of that. And then when that happens, of course, that the active side, today that'd be quantitative easing and tightening, can offset that if that's your particular goal. So that's, for modern central banking, the sort of a cautionary, eyes wide open, that you get into these passive facilities, these standing facilities, the volumes can get very large very quickly. It can be very popular stuff. And you might want that, of course, but just heads up. Now, of course, there's a great deal more in our bank than a book, I'm sorry, that we're able to get to in just 40 minutes. None of this that I described to you was intentional when the bank was created in 1609. There's a long evolution of sort of stumbling and bumbling their way into this successful situation. And also, we would stress in the book that the success of all this, the stability of all this, was dependent on political economy. And when that political economy shifted, especially in the 1780s and 90s, the bank's ability to do what it wanted to do fell apart fairly quickly. And so, of course, political economy matters a great deal. And then also, we would stress that the success of the bank here was important for much more than just Amsterdam. It mattered for all of Northern Europe, not just the bill market. So, chapter 8, for example, has this great story of Frederick the Great during the Seven Years' War, engaging in a great deal of debasement. And he acquired much of the silver and gold he needed for that from Amsterdam using credit in Amsterdam, and both the credit and the metal using the bank. And so the bank was very important for Frederick, for example, winning surviving, let's call it, the Seven Years' War and the rise of Prussia. So the point being that the bank was very important for European history also. And with that, I believe my 40 minutes are about up, and Will and I look forward to your questions.
Okay, thank you, Steve, for this fascinating presentation, a glimpse of the book, and so I remind people to put their questions in the Q&A at the bottom of your screen. So maybe I'll kick off with a couple of questions to warm things up. So I had two questions, Commons questions. One is, to what extent the practice of the Bank of Amsterdam evolved from the pre-existing bank, which was kind of more characterized like a pawnbroking type of operation, where sort of you deposit something, you get some claim, you have some option to redeem, but not bullion. I mean, they engaged in that. I don't know what they engaged in, but I don't remember.
Yeah.
But there was this bank that in the previous 100 years it operated in Amsterdam. So to what extent this was modeled in some sense, it was also a state bank, the City Bank. So to what extent there were some similarities in the practices or kind of an institutional memory there. And the other question relates more to the choice of gold and silver. We know at the same time the Bank of England is favoring gold, and so to what extent this is explicit, or is it is it some kind of an agreement, or is it kind of tacit agreement? Do you take this market, we take that market, or they don't want to get into each other's territory, or that would be interesting as well.
Right. On the first part, the evolution of the bank to the story we've got here is long, circuitous, with many subplot points. But to summarize, when the bank was created in 1609, it was a traditional deposit structure. You put coins in, you got bank money, and when you wanted it back out, the bank gave you the coins it wanted to give you. But every bank florin had an inherent right of redemption. So just so traditional Anglo-American banking story. And all that slowly breaks down because the bank was trying to navigate a wide variety of coins. So Amsterdam, not just having Dutch coins, but all the world's coins are flowing through, and they're trying to navigate this very complicated world. And they eventually ooch their way into this receipt system, which critically allows each coin to have its own price and its own little market. And so the bank could sort of start compartmentalizing the coin flows. So it didn't have arbitrage, for example, people putting in gold coins and taking out silver. You put in gold coins, you had to take back gold coins. You put in silver, you had to take back silver. So that's the contribution the receipts start having at first. But then the bank discovers that people primarily take coins out using that facility because it's so cheap, it's so convenient. Everyone likes it better than traditional, oh, you just get whatever the bank gives you at a pretty high fee. So the bank would charge a pretty high fee to withdraw. So they 0.5%, 0.25% were much lower. So everyone loved the receipts. So they just start quietly sliding over to saying, well, we're just only going to have receipts. And then they eventually quietly just say, yeah, we're just not even going to recognize an inherent right of redemption anymore. You could only turn your bank balances into coins using a receipt. So if you want coins, go buy a receipt from somebody, is what they say. And we think that little final transition, conceptual transition, had to do with bookkeeping, because when you had the people could always redeem a coin. Boy, they had a gazillion kind of coins, and the bank had to handle all this. But when they switched to this system of only receipts, it cleaned up their books tremendously. And if you actually look at their books, the transition period, it's amazing. Well, now they only have to keep track of these particular coins that are under receipt, and they were scrupulous about that. Everything else was the banks. They could do what they wanted with it. They didn't have to worry about interacting with customers. And so that's our story of how they sort of ooched their way into all of this, accidentally. And then they discovered, like other central banks discover, wow, hey, we can do open market operations. We can do all this stuff. Yeah. So that's our story on your first question. On the second one, Will, do you want to talk about gold?
Yes, I can say a little bit. The receipt system was actually proposed in the 1670s after some ructions that resulted from the Dutch year of disaster and the French invasion of 1672. And it was known that a new system was needed. And reading the original proposal, I sort of get the idea that they were focused on silver. There was not really that much gold available, and gold was sort of a sideshow. What they could not foresee, they couldn't foresee the discovery of gold in Brazil, which dramatically increased the amount of gold coins available. And then there was another little item that they did not foresee, which was the whole John Law episode, which sent a tidal wave of gold into the Amsterdam market at the end of War of Spanish Succession. And so part of our book is the history of the bank fumbling around with gold during the John Law episode. And bottom line is they end up for a while in the 1720s, kind of the monopoly gold dealer in the Amsterdam market, and they have to do some adjustments after that. So the bank was, in a way, not really. I think it viewed during some periods gold as just, to use a non-technical term, a pain in the ass to their main silver business that they wanted to do. I'll stop there.
Okay, thank you. So I think we have a few questions now in the Q&A. So maybe I'll try and unmute the. So we'll start with Guillaume Dada. I'll try not mute you. Just, yeah, yeah. I think I unmuted
Yeah,
you, Guillaume. Yeah, go ahead.
does that work? Yes, thank you very much. Well, apologies, this is a bit naive, but I was trying to understand what was the objective function of the bank, because looking at this balance sheet, I had the feeling that the share of assets that could lead to profits seemed pretty small, as coins do not pay interest, right? So how do they make money, or maybe did they make money mainly basically because of the fees, or didn't they want to make money? Why were they doing all that?
Right. This is a great question. You'll be shocked to know they never made a formal policy framework statement. Um, but our sense of it is the city was not had no problems with the bank making money, but the primary goal was to stabilize the value of its money in relationship to coins. That was its primary job. It was literally created to do that. And so that's why they were so focused on, if they could, keeping these bank price for their receipt facilities or the staying facilities so stable for as long as they did not manipulate it if they didn't have to. But they certainly welcomed profits. And the two things that made profits were the lending to the Dutch East India Company, the credits, if you will, was a profit source, and over time that could vary substantially how much the company borrowed from the bank. So those profits were variable from year to year. But the other thing that was profitable was this throughput of coins. You're absolutely right. The coins themselves don't pay interest, but all those receipts do. And so all that throughput, they're taking their little cut of all the throughput, half a percent for the gold, quarter% for the silver, half year, and that was a very reliable income relative to the loans. And so that was a profitable side of things. The bank more than paid for itself. And then again, by this era, every year the city would just scoop up the remainder. The other thing you'll notice on that balance sheet was the city would borrow from the bank. Of course, the city also owned the bank, so it wasn't really borrowing, and it didn't pay any interest on it. So basically, the city could tap the bank as a sort of a form of capital if it needed. And so that, and again, that was also not public knowledge that the city would do that, but it did. And so, from the city's perspective, the bank was also an emergency cushion when it needed it.
Thank you.
Okay, so try to move to Alejandra. Let's see. Yeah, so you're live. Yeah, Alejandra,
I
y- are
I
you?
can I can read her comment, and yes, she's correct that I was saying across the Atlantic, but you're absolutely right, Alejandra. Some of it did go across the Pacific to the Philippines.
Oh, there's another question. If the bank managed the agio to attract silver coins to the bank via the price of silver in their money of account, how did the agio relate to the rate of creation of the ledger money? Can you spot any relation?
Right. When we first put some of this series together, anyway, uh, we thought that in a sense, the bank's primary goal in this period was stabilizing the agio, the relationship or the premium between bank money and local money. And we got all the data together and ran the VAR and the whole bit. And no, not really. It seems as if they were letting the agio respond as it would unless things got pretty extreme. And instead, putting together the data revealed what they were instead focused on was stabilizing the quantity of their money. And again, we don't have a formal statement that this is what they were doing, but the data certainly reflects that, and the statistics, reflect that. And so it seems as if they were mostly letting the agio float, and the stabilization of everything else was kept it reasonably in line.
So we'll try and unmute Miles. Yeah, go ahead, Miles.
Hello, thank you very much for this great presentation. I was wondering regarding the mechanism of the haircut that you described, it's really interesting. And I was wondering whether you have any archival evidence from, let's say, merchant correspondence referring to such a mechanism being useful to them or them profiteering from this mechanism, from the haircut.
Steve, should I
Yeah, please.
take this one? Could you bring back the basic diagram of the market? I think it's early in your
Sure.
presentation. Not the receipt, but the picture of the players. Yeah. Okay. So modesty demands that we admit that for this book we only cracked between 1% and 2% of the transactions of the Wisselbank, and particular, we did not we focused on the master account, the account of the Bank of Amsterdam itself. And there's been some subsequent work by my colleague Stijn Beer at the New York Fed and Christian van Boeghoven at Utrecht University that has made use of about 95,000 transactions of private parties through the bank accounts to sort of fill out this liquidity story. How is metal being converted to bill liquidity, and so on and so forth in the Amsterdam market? And their story's pretty interesting. There's kind of this organic liquidity mechanism going on in Amsterdam that starts with, if you can see these precious metal dealers on the top right, these are little firms, German Jewish firms with connections all over Europe, including places like Cadiz, Gdansk, London, and they pull in coins using bills of exchange drawn on the big guys, the merchant banks, Hope and Pels and Clifford and so on and so forth. And that creates this pool of liquidity in the bank, which can then get passed around by various other participants. And when that metal leaves the bank, a lot of times it leaves in big batches, organized by the merchant banks. But it's a pretty smooth story. Now, going back to your question, where you would find evidence of that is that there's a sort of complementary archive available through the City Archive of Amsterdam of protested bills. And this is what Stein and Christian have made use of, where you can actually track sort of the path of metal coming into Amsterdam via these bills. And that is where you would find the smoking guns. But we just didn't get to that. We know that some other researchers are headed in that direction, and we want to encourage people to use those available resources. It's certainly a lot of it would be easier if the entire ledger archive were digitized, which is still a dream, but maybe not that far away right now.
Thank you. So I think we have, there's one clarification questions by Diana Minon about 1726. So I think it's a year where you don't have data, right?
Correct. So the accounts of the bank is actually you'd be shocked to know a complicated world. There's the ledgers where the money, excuse me, the bank money, the paper money is recorded, and then there's a whole separate set of books for the collateral books, if you will, the coin accounts. And for 1726, we do not have the coin accounts, the so-called cash books, which tell us when a transaction is an open market operation versus a receipt, and if it's a receipt, what kind of metal and all that stuff. We don't have that for 1726. There are other years we don't have it either. But for 1726, for some reason, the balance sheet just doesn't come out right. And so one of my long-term gnawing on a bone kind of thing is figuring out why the books in 1726 just don't work. And so we just didn't include it for our book, but it is an ongoing exercise, and what it speaks to is how superb the accounts were kept all the rest of the time. That you can reconstruct a great deal, even if you only have partial accounts, because everything locks down so tightly. But 1726, it doesn't, and again, one of my summer projects is to figure out why.
Right. So I think that brings us very, very close to the end of the hour. So let me take the opportunity to thank you again, Steve and Will, for presenting the paper and commenting on the questions, and thanking all the audience for joining us for this seminar, but also for the ones that we had earlier this year, and also to remind people that in the fall we'll resume our online series for another year. So with that, I'll say goodbye to everyone, and we have another 15 minutes of informal questions. There are still questions in the Q&A, so we have plenty of stuff to chew on in the next 15 minutes. So bye-bye to those who wish to leave now. Okay, so there are there are a few more questions. Let's see if people are still around. Yeah, Juan Jose Rivas Moreno. So if you want to ask your questions, I unmuted you.
Yes, thank you. First of all, I really enjoyed the presentation. Very interesting. I just had a question by way of clarification that I think is related to Alejandra's question of the Agio. So I think that it may have been partially answered, but if I understand correctly, these merchants, they bring their coins, their physical coins, their trade coins to the bank. They get the receipt, but these coins get converted into Banco money. So my question is basically is if the bank itself, the bank board, the bank clerks set up a sort of exchange system, if the price of these trade coins um, denominated in Banco money varies during the period, if they set up their own like sort of exchange rate system, or if it is just fixed.
Right. It's usually fixed. That's the short answer.
Fixed.
And for silver, it's fixed. They just don't want to change it. And for gold, they don't want to change it. It's very clear that this 5 Bankflorin per gold ducat in the Kaiser example is what the bank wants, because when it can, it has that amount. Then when these disruptions occur, these negative haircut disruptions occur, the bank eventually lowers that price, but it's temporary. And when the markets recover and the arbitrage pressure passes, the bank goes ahead and ooches its price back up to 5 Bankflorins again and then resets it there. Why the bank wants to keep these prices so stable, because it's obviously very different than how central banks operate today. We think goes back to that era when they were coming up with this stuff. It was all actually in the previous century. And it seems as if the banks took its stability mandate as maintaining the price of these coins in bank florins. As this is the stabilization that they're really about, and that's why the agio was left afloat, if you will, because it would be the adjustment mechanism, and that's how it worked for silver for well over a century. It's amazingly stable, and what that meant was if you were a merchant bank dealing in Spanish dollars, for example, you could count on the price of Spanish dollars in bank florins in Amsterdam. That was rock solid. In a sense, it was a fixed exchange rate regime that they were setting up with trade coins. Again, not with the local Dutch money, but with the international trade coins that flowed around the world.
Very interesting. Thank you very much.
So I'll try and mute Victor Perez Sanchez. But following up on the previous question, I guess that relates to my first question about sort of in England, you had a stable price of gold. And so, and in Amsterdam, stable price of silver. And this kind of creates this de facto band or something between the two precious metals, which is very interesting.
I think that's right. Yeah.
So the agio is somehow constrained in some sense by these four things. So, but let me unmute Victor here. Yeah, Victor, you're live.
Yeah, hello. Yeah, I hope you can hear me. Thank you for your presentation again. Yeah, it has been very interesting. My question is regarding the private account holders, the role of the account holders in managing this stable balance sheet, because it seems to me I mean, the argument is that the bank is the one doing it, but I wonder what's the role of account holders. Because, for example, I can think of that the expectations on the future scarcity of silver currency will encourage the holding of these deposits or not, or the rolling out of these deposits or not, of these receipts or not. And that will affect the stability or preserve the stability and change the portion of the fiat portion of the bank and the receipts portion of the bank. So is the private role on this stability of the balance sheet?
Do you want in, Will?
So if I may chime in here, through this research that I mentioned a minute ago, something we should have focused on a little more in the book, but it's still good to know. I mean, there are two parallel pools of liquidity basically in the Amsterdam market at this time. And one is in the Wisselbank itself, the Bank of Amsterdam. And the other is in these merchant banks. These are absolutely huge institutions. They're not commercial banks in the modern sense. They're a combination sort of trading firms, investment banks. Nonetheless, there are so many people around Europe who use these banks. They have the equivalent of deposits. People just simply keep balances with hope because they know that if they need uh, liquidity in Amsterdam, that balance with hope, for example, will become very useful. So the combination of those two pools of liquidity is basically what attracts so much business to Amsterdam. Someone can easily draw a bill on one of the large merchant banks, the GSIBs at the time. One can move silver via the Wisselbank to Amsterdam, where it can be moved around Europe by one of the large merchant banks. So part of the story that we understand only incompletely at the time is sort of this complementarity between the large amount of liquidity at the Bank of Amsterdam and at the private merchant banks.
Thank you. So I'll try and unmute Alejandro again. Let's see if it works this time. Alejandro, go ahead. You still have problems? Yeah, I guess there's some kind of a technical issue here with Alejandro's mic. So
Mhm.
I'll keep it open. Maybe she drops, but maybe a follow-up. But so I'll read her question out loud. So Alejandra fears that you have misread her comment. It's not to do with the flows through the Pacific, but that the measure you take is not the arrivals of coins to Europe, but the production of coins in Spanish America. And what it means that your ratio may be even higher. So once you're kind of scaling it by stuff that actually landed in Europe and not went somewhere else.
That is a fair point. Yes. We don't. Well, at this stage, let's say um, there are measures we could try to use for the actual transatlantic flows. I guess we decided at the time scale we're looking at that it's all close enough. But Alejandro, that absolutely true, and maybe that'll be worth cutting a bit finer, especially if one can start getting a sense of the how much was being shipped from Cadiz, let's say, back up into Amsterdam and Northern Europe. Yeah. Thank you.
Okay, so I think we ran out of the question in the Q&A. I don't know if Rui has his hand
Yes,
up. So
I do. So now that the specialists have spoken, I can start asking speculative questions. So you focus on the implications of central banking, and they're all very opposite. But of course, one of the consequences of the success of the bank florin is that it became an international reserve currency, right? Probably the first in Europe. Could you speak a little bit about the trade-offs that created? Because essentially you're opening up your balance sheet to all the instability around Europe, right? Because you're issuing, right, the safe asset by definition. And whether you see any connection to the fiscal side, right? So the continuation story, right? You have this happy marriage between the Bank of England and the British debt management office, essentially the same, right? But I don't think this is a story in the Netherlands, right? So perhaps the origin story of the bank as essentially a mechanism to stabilize the value of metallic money rather than stabilizing the value of government treasuries. Thank you.
Do you want
As,
to?
as, as a retired central banker, I think something the Wisselbank did do, which a modern central banker might have warned them away from, was first they operated in Amsterdam with no capital controls, right? No controls essentially on the flow of bullion in and out, which is one of the things that contributed to the exorbitant privilege of Amsterdam, if you will. Then they had these receipt redemption fees were fixed interest rates. And then they also basically tried to stabilize an exchange rate of bank money versus, they tried to stabilize a domestic exchange rate, but this was as good as a real exchange rate, foreign exchange rate. So that combination is known in the modern world as a trilemma, and toxic things will happen. And you're inviting either a currency crisis or a financial market crisis, and we argue in the book that the crisis of 1763 was sort of a case study, and the truth of that proposition. They were overwhelmed with capital, with bullion inflows. They really didn't know how to manage it. The situation in Amsterdam developed into sort of a bubble, and it was popped by the explosion of one shady deal in August 1763 and subsequent violent contraction of the bill market. So, yeah, I mean, there's some there's some echoes of modern central bank, wisdom that showed up in this history. But maybe the most interesting part to me is it's easy to throw around the term exorbitant privilege, but maybe the most fascinating part of this whole exercise to me was the microstructure of exorbitant privilege. How did this liquidity arise? And it wasn't as if the Wisselbank just invented the system that Steve talked about, and a day later, Amsterdam had exorbitant privilege. It was sort of a learning process of these players that gave rise to this organic whole. I don't know if Steve wants to add something to that.
Well, just yeah, I would characterize those flows, those silver flows, as the benefit and the cost of being the reserve currency. You just had these. You have a standing facility as reserve currency. You can get massive swings in the amount of stuff depending on what's going on, of course, in the rest of the world. And then at least within what we know, that response to that is, in a sense, they're using their open market operations to manage the volatility of the standing facility because it is the reserve currency and getting these massive swings, and they're just trying to stabilize it. again, all this was private. None of this was known publicly at the time, but that seems to be operationally what it meant. And of course, for Amsterdam, to follow up on Will said, I mean, the merchant banks, the great merchant banks in Amsterdam in the century were huge, powerful, wealthy, important, network connecting entities. They were the Goldman Sachs of the day, and so in that sense, that was it kept a lot of financial operations in Amsterdam that might have migrated to London, and eventually did, of course, but at least when the Dutch economy maybe didn't justify it.
Thank you. So we have like 10 seconds. Guillaume, Dodin, I think you mentioned it, but if you have evidence of the market price of the receipts.
Oh, goodness. Do we ever wish we had that? Oh, my goodness. No.
Yeah, that's what I remember from what you said.
Yeah.
Okay, so
These prices are we liken them to finding evidence of dark matter. You only see it through the other thing because no one recorded that. It was just because it was, again, it was an options contract on the side. It wasn't the main thing on anyone's balance sheet. It was just this little side thing you did, and you paid for it separately. And yeah, we have
Traded
not found.
OTC traded over the counter.
Yeah, we haven't found. Don't get me wrong, we've looked, and if you ever find any, whoo boy, let us know. But no, we have not found that.
okay, so this is on this note. Thank you again, Steve and Will, for joining us, and see you all next year, next fall.
Thank you. Have a
Thank you
great
so much,
summer.
Nathan.
Great summer. Bye bye.
Bye.